Welcome to Sink or Swim, presented by Squid Group, your digital marketing partner. In this podcast, we talk to Mark Highfield, a mortgage broker from Majesty, who isn't your normal corporate broker. Mark has worked on the oil rigs in Australia, alongside being a snowboarding instructor in Europe. We discuss which banks are best and the difference between getting a loan as a first home buyer to a business owner, alongside some of the ins and outs of using a broker compared to going direct to the bank. Hope you enjoy it.
Hey, welcome.
Cheers for having me.
It's good to have you here.
Finally got there.
We did.
Finally got
It's
there.
been a roller coaster, but hey, the joys of having kids.
Joys of having kids and life. And life getting in the way. So yeah, cheers for having me.
No, it's all good. So, just to kick things off, I'm really interested to know, what would your superpower be if you had one superpower?
Oh, flight.
Flight.
100%.
Really?
Be Superman. Go because you could just have moments where you could just go and go and lie in the clouds. Just
Really?
step away from it all. And if you needed to go somewhere, you can go. You can fly.
Interesting.
Non-negotiable, yeah.
It's been
Flight,
I've had a
100%.
lot of discussions about this recently, and flight's always the first one, but then people start to think about it and they're like, teleportation, I want to be able to control the weather, I want to be able to go back in time.
Flight, because flight, you can counteract with teleportation. You just get there a little bit slower, go back in time. Well, what's done's done. Don't live in the past, live in the now. Probably my motto of life. Like, it is what it is. So, flight could just make life a little bit easier.
Sweet.
So, yeah. So,
And so tell me a little bit about yourself. Like, how did you get into what you're doing now? You're obviously a mortgage broker.
yeah.
But I know that that's not where it all started. So
Yeah. So, now a mortgage broker. Been doing this a couple of years in this space. But, yeah, previously I worked in the resources industry for 10 years. So, oil and gas, offshore oil rigs, onshore rigs and land. Did that for 10 years in Australia, North Sea, so in Europe, Middle East, Asia. And then before that, as a young Englishman travelling the world, pretending to be a snowboard instructor and just trying to work out where your life is.
Yeah.
You know, because, it's probably the best advice I'd ever say to anyone. I don't know what to do. Get a plane ticket and go and see the world and go work out how you want to dictate your life, not how someone's going to tell you. So work out what you like. And but mainly 10 years in the grind of working on big steel structures in the middle of the ocean or in a hot sandy desert. So that was my life pre-drinking coffees and meetings and talking about home loans and interest rates and the housing market daily. So bit of a change, but it's cool.
And so where would you say some of your, besides the oil and gas stuff that you've done, where would you say is your favorite places you've lived, or any of where have you been that's sort of memorable?
Oh, yeah. So everywhere's interesting. Me and my wife, we spent a lot of time overseas. Over the last decade, we've been back and forth from New Zealand. I used to work 4 weeks on, 4 weeks off. So when you're in your mid-20s, you go to work for 4 weeks and then you have a 4-week holiday. So go and see the world. I think everywhere's different. We lived in Europe for 4 years, so we had this amazing aspect of just being able to get in the car and drive around. That's a difficult question, yeah. I don't know. I don't know, because everywhere's unique. New Zealand, it's got to be the most beautiful, chilled, relaxed country. There's nothing you can't do here. You want to go skiing, you want to go surfing, you want peace and quiet, here's the spot. But then also, being in Mexico City and the hustle and bustle, and there's 25 million people moving, that's pretty fun.
Yeah.
So, I like the Americas. I think they're such a cool place to discover and go. So yeah, like Mexico, and because we went all the way down the Pacific coast. So started in Mexico and then ended in Costa Rica.
Cool.
So yeah, I couldn't. I'd do it just the service, saying which one's better.
It's a totally different world, like in terms of travel, when you start like seeing some of the different stuff that goes on. Like one of my mates, he lives in Mexico City.
Yeah.
Full-time professional poker player.
Nice.
It's a different sort of lifestyle, but like the people that he meets in Mexico City compared to who he meets here, is just like a totally different world.
And the stories, stories are insane. I got this. So we're in El Salvador. We're in our obviously mid-20s, and there's a Kiwi boy from Rotorua that's at the hostel talking to us, and he's telling us about this story in Colombia. I think he's getting a night bus between Cartagena and Bogota, so a pretty long journey. Out of nowhere in the middle of the night, they feel a massive thump, and it's like, okay, that's a bit weird. And then anyway, continue on, and then when they get to their destination, the whole story of what the thump comes to light. So the bus was driving in the middle of the night. It's hit a cow on the road, killed the cow, but all the workers have thought, sweet, free feed. So they've got this cow and they've stashed it under the bus, but they've put it under the bus next to the engine. So slowly, as this 8-hour journey's gone on over the night, the cow's been getting cooked from the heat of the engine, and then they've got to Cartagena and then pulled their bag out, and it's all covered in God knows what.
Yeah.
But you just hear these funny stories, and the way he was telling it, having a beer, you know, like it's funny. And you just come across so many South African stockbrokers that are going to America on fake green cards. Like the stories are great. But I think it also gives you, back to the first point, what I was saying is you can understand, like, you work out what you want to do.
Yeah.
You know, like go and work out what you want to do.
And so often you'll go somewhere and you'll be like, you get these ideas of what's going to be amazing. And someone will be like, oh, you've got to go and do this and you got to go and do that. And then you go to those places and you're like, that was shit.
Yeah, that was crap.
And then you'll go to somewhere else and you'll be like, that place is unbelievably great. Yeah. Like, I never really thought that I would like Tarragona and like the east of Spain. And it was epic. Like, I managed to sail from Nice down to Tarragona on a super yacht. Yeah. And then we like stayed in Tarragona for like a week and a half. So then we were just in Tarragona, and it was just like this epic little place that you could just catch a 1-hour train up to Barcelona if you wanted. Yeah. But then like you're in like a little bit more authentic.
Well, I'd give you a prime example for that is like everyone raves about Costa Rica. Costa Rica's like, for us in the Southern Hemisphere, it's like our Indonesia. Like, you go, it's for the Yanks. You go to Costa Rica, yeah. It's overpriced, and it's just wild in the sense of there's Americans driving around in ATVs everywhere and all this, and I was a bit blown away. Whereas in Mexico, the food was great. It was chilled. I was like, this has been amazing. Like, and so, yeah, you exactly as you say, you got to go and also you just find the hidden gems. Yeah. So, but yeah, I just think that also is a good basis to set yourself up on for life. Yeah. That's my opinion on it.
And so how did you get from like the UK into oil and gas and then to mortgage brokering? Because that's not exactly your normal transition.
No, it's not a bit, no. So I was, 18, left the UK, was going to join the army. Why? Adventure, excitement, travel the world. So that was my kind of thing, but I took a gap year, went snowboarding. Worked out that snowboarding, working on the hill during the day was quite fun, and drinking beers at night was even funner. When you're an 18-year-old boy, so it was an like, and then sort of followed the snow around the world for 3 seasons. And then I kept bumping into some of my like family friends who are ex-military, and they were transitioning out of the military into private security, and they were working on the oil rigs. And they were like, you work 4 weeks on, 4 weeks off, and you can dictate your life. And I was like, oh yeah, that sounds like a bit of me. And then, sort of my wife, who's a Kiwi, We met when we were living in Switzerland, and then we came back here, and I just sort of made this pinpoint focused goal of, I need to get offshore. I need to work 4 and 4. This is what I want to do. My qualifications are, I'm a snowboard instructor. Coming from England, not very handy with tools. So
I would say a lot of pommies aren't that good with tools.
No. Yeah, my dad's mentality was take it to the mechanic, son. But then when I'm out in the out bush with these Aussie boys that have been riding motorbikes, stripping engines for their whole life, and I don't even know the difference between an imperial metric spanner at 19 years old. Like, right, okay. So, and you just find a way. You just find a way to work out how to. So I worked my way up. I got onto a land rig, a small one, then went from there. Then eventually got sponsored. So became obviously an Australian resident, permanent resident, and then went offshore. And then I called a lady for 2 years, an offshore recruiter, and I couldn't work for her because I was currently working for another company. But I called her for 2 years and said, "Hey, I'm gonna come work for you, just to let you know." And I called her for 2 years every month, saying I'm gonna come work for you. And then eventually, when I could go and work for her, she gave me a job just because I was pestering her so hard. But I was just laser focused and just had to get that. And then, got into the game, and it was good. It was interesting space.
And how would you, like, that's interesting about how you sort of got into it in terms of, like, you just kept going at it until you got where you wanted to get to.
Just got to keep going.
So how would you say that in terms of, like, so many people you hear about them wanting to do something and they're like, oh, I really want to have my own business, but they never actually put plans in place or take the plunge to actually do it. So how would you relate that back to yourself? Because obviously you managed to get yourself a job somewhat in the industry.
Yeah.
But then that mentality, like,
you got to search deep in your soul. Like, I remember being stood in the shower. I have $100 in my bank account. I stood in the shower. I'm 21 years old in this hostel, and I just keep getting rejected. No one's going to take me on, and I just had to go deep and dark in my inner soul and go, it's okay. In a year's time, you will have a job. You'll be earning good money. You'll be doing this. Just keep going, and it's hard to explain. You just got to keep going. You're going to get knocked back. Even the most successful people in life get knocked back all the time. You're just seeing the end of where they got to, or even part of their journey. So, and you've got to fall over. You've got to fall over. You've got to get knocked back to keep going.
Yeah, it's funny how people don't see the downs, right? Like, I remember when I was doing windsurfing as my full-time job.
Yeah,
everyone had originally said, you can't be a professional windsurfer and make a living. And I was like, well, I'm going to make it work.
Yeah.
So I did that for, 3 years?
Yeah.
But people also saw the joy parts of it.
Yeah.
But I also remember that, like, your situation, I remember being in Spain and having, I think I had like €70 left.
Yeah.
Because I had just been robbed on the beach in Tarifa.
Yeah.
So I was like, just been robbed. I had all of my fins and everything that I used for racing. So now I didn't have the tools I needed for actual competition. And then one of my sponsors at the time, I won't say whom, who said that they'd always support me if something like that happened, told me that they weren't going to be able to, like, in what I see now as being a nominal amount of money, but they couldn't even give me anything near like $3,000, which would have literally just covered me. And then I remember being like, what do I do? Do I call my parents, or like, how do I get around this? And then I was like, I'm not calling my parents.
Yeah.
And then for the next month, you just live on beans and rice. It's great.
It's just
that you figure it out.
Figure it out.
And those are the things where you realize that if you actually are in a tough position, if you put your head down and actually start to grind it out.
Yeah. And it's not going to be a fast process. It's not like, oh, right, today the date's changed and now we're on the other side. No, it's just it's a long process, but longevity and consistency is two key attributes that I've sort of seen, especially in that game, but probably in most of the games in life. They're the two things: consistency and longevity. You excel at those, you'll be fine.
And so how do you reckon that relates to like people, first home buyers wanting to get a mortgage? Because that's a great little tie there.
Consistency and longevity. Like right now is difficult for like not difficult, but look, you see it. Everyone's talking about it. You see it in the news. House prices, they are high, and first home buyers, they feel deflated. They feel like they can't get into the market. But the thing is there are bank systems and things in play in New Zealand that can actually help first home buyers get in. And they're actually wonderful tools. You know, the fact that we can access KiwiSaver in New Zealand, have to be one of the only countries in the world that you can access your full retirement fund and only leave $1,000 left in it to buy a house. It's pretty cool. Like Australia, they changed the rules the other day, but you can't pull the full amount out. Whereas here, you only need to leave $1,000 in. But then also I am very aware that the other side of it, of like, oh no, just keep saving, you'll get there in the end. Like that's not going to wash either. That's because if the market's moving and you're still saving. So yeah, it's a bit of a double-edged sword, but first home buyers actually right now in today's market, where we've seen prices nationwide, you know, over the last few years come down between 20 to 10%, whatever market you're in. It's a broad generalization. They actually have a great opportunity to get in. So if you just get in is my, like, if you can just get a foot in the game and just work it out. Like, obviously we don't want to be living on
beans and
rice. And I fully say that to all of my clients, and we all do as a firm as well. Like, we don't want to be living on beans and rice and put yourself in a financially challenging situation. But it's also a bit of a nervy plunge. Like, oh, I'm going to be in debt. Oh gosh. Like, well, there's just chapters in your life of where you're going to have the good parts and the bad parts, and there'll be a few years of consolidation, right? Okay, maybe we can't go and have our avocado on toast and coffees every morning, you know? Like, you've got to just knuckle down. But there is beautiful tools in place. KiwiSaver, first home grants, KO first home loan. That's an amazing product. So it allows first home buyers that don't have 20% deposit to be viewed as if they had 20% deposit. So it gives them a great entry into the market. You don't want to be saying, just keep going, it'll be all good. You've just got to take the plunge, sink or swim.
Yeah.
Get involved. Like, right now is a great market for first home buyers nationwide, because you're not fighting against developers, massive amounts of investors in the market at the moment. You've got a pretty good run of the monopoly board. So have a go.
And so when I remember getting my mortgage a while ago now, I was like being told by some people to go to banks direct, because you're going to be able to avoid the whole mortgage broker situation of like them having to negotiate on your behalf. But I went with a mortgage broker. Do you want to maybe just explain the difference and why people would potentially go with a broker versus a bank? Because logically, in most situations, people always think direct, cheapest.
Yeah. And so there's a few stigmas with the whole, so especially a lot of the older generation. I've banked BNZ all my life. I'm going to go to BNZ. Well, no, Terry at BNZ. Terry's going to get me a good deal. Terry's just a worker at BNZ. See, You are a name and number in the cog of wheels, and the trade is moving forward. Your cog will be replaced. Right. So there's no we sometimes as humans like to get this psyche of we want to be loved and felt, and I'm not saying the banks don't do that, but you're just a name and number in reality. So what is the issue at going to this singular bank by yourself? Is you're only getting the one choice of ice cream. And what clients don't realise is actually every bank's policy is so uniquely different in certain aspects. Whether you're a self-employed, business owner, PAYE, you may work in Australia, so you may be overseas income. So if you just go to one bank, it might not fit your situation the best because you don't know the policy. So what does a broker do? A broker works for you on your behalf and analyses your situation and sends you to the best lender for your situation. How does the broker get paid? The broker gets paid by the lender. So the lender pays the broker on the commission, which is a certain percentage of the amount of the loan. So in theory, the client doesn't get this up front. But then there's also sometimes a slight misconception that the service is ultimately free. If the loan is closed within different banks range 24 months, 26, 27 months, then the bank will charge the broker a clawback of a certain percentage of the commission, which can be passed on to the client. So that is one aspect that slightly, I think, gets lost in translation. People have to be very careful when they're saying that four-letter word free, because technically it might not be, but a broker is working for you on your behalf to achieve your best outcome. And yeah, like we've seen situations where there is 6-figure difference in lending capabilities between institutions and all the same information's being provided. Now, you might not be price sensitive and might not be needing that extra, but if you are needing that extra, you've just sort of pulled yourself out of that opportunity.
Yeah. And what would you say what is the difference in those structures, like Westpac versus ANZ versus BNZ, like for
brokers?
For brokers.
Yeah, because it's all public information that has to be disclosed to our clients. So certain banks will pay an upfront commission, a certain percentage of the loan straight up front, and then others will pay a smaller amount upfront, and then even tinier amount as a monthly retainer, which they call trail. It occurs in the lending space, the insurance space. These are all so yeah, each banks have different structures, but they're all actually pretty much when you put the numbers together, they're all the same.
And so how does it work then in terms of like Westpac, I'm pretty sure, is a trail.
Yeah, they're a trail bank.
And then BNZ, I think, is a more of a upfront. Is that right?
No, they're very similar to Westpac as well.
But so let's say the ones, or even Westpac, you've got your period of your loan. So let's say it's you've got certain ones fixed at 3 years and 5 years and so on and so forth. When you refix, does the mortgage broker then get repaid again? Or
no,
so they wouldn't?
No, because so if you're with a trail bank, you'll, in theory, the bank's view is you're getting paid every month. So it's your due diligence to ensure your customers care. So the brokerage is, and I've got to be careful in the way I say that the broker's getting paid, because brokers' employment structures in New Zealand are very different. They're self-employed, salaried. Some brokerages don't pay their brokers trail. The brokerage takes the trail. So got to be careful in that. I don't want to generalize any broker under that banner, because they are all different. But yeah, if you're with a trail bank, the broker isn't going to get paid, or the brokerage isn't going to get paid up front for a refix. With the straight up front banks, it's a minimal, tiny, like not even a couple $100 refix. But it's all to do with that customer customer care, engaging, because I think sometimes we're now in a different market where pre-me in a 2019, 2020 booming kind of market, unfortunately, some brokers gave poor service to their clients, which can leave a bit of a distaste in the mouth, and this is why there can be a bit of a negative attitude to brokers. But especially our firm here, we're very our customers are our number one priority, and you want to be hands-on with your customers at all times. So whether it's trail or non-trail bank, it's
100%.
I say it's a bit of a crazy comment. People go, what? Like, but I'm like, right, well, here we go. This is the start of the 30-year journey. 30 years? Well, your loan's 30 years. We're with you the whole way. You need a refinance, you need to do anything, we're here the whole way. So, but yeah, it's a good question because not many people really understand how we get paid or how the industry works.
And so for people looking at getting a loan, or let's say you've got your mortgage, first home buyer, and you've now earning more money than when you originally got your loans, so you're now able to pay things off a lot faster and everything like that.
Yeah.
What would you say is the options / recommendations, like in terms of either paying down your loan as fast as you possibly can so that you always have no mortgage on that, and then say you can buy a house later on, versus say keeping the mortgage ticking but then buying an investment?
Yeah, good question. Open-ended. Totally unique to the individual situation. I've got friends, clients that don't want an investment property. They just want to pay their mortgage off as fast as possible. And that's there. They're just happy. I've got other clients that want to be the next Donald Trump and have own half of Auckland. So it's all to do with, firstly, personal appetite, but then the reality is you're going to have quite heavy lending restrictions here in New Zealand, because what we've seen is we saw 50% house price increases in 2 years. Put that in perspective, that's a decade. That's 10 years growth in 2 years. So this is why the market went hyperinflated, and then now we're on the other side feeling the pain of that. But there's certain rules in ownership. If you own an owner-occupied, you need 20% loan-to-value ratio. So that means you either need 20% full cash deposit still in there, or it needs to be made up of equity. Layman's term for equity is it's just that your property is increased in value, and that imaginary money is viewed as a gain and put aside. So in your owner-occupied, you'd need 20%. If you're going to buy an investment, and it's difficult to say this now because the rules are going to change in June, July, is you're going to need 35 right now, but 30% in June and July when the new debt-to-income rules come in on an existing. If it's a new build, you need 20%. So when you actually look at property prices here, let's talk about $800,000. You have your owner occupied at $800,000, so you need 20 in there. So there's 160. But then we're going to need 30. Well, there's 240. That's quite a bit. So it's all about how you're structuring and work. And yeah, so it is. The game is to have your owner occupied paid off, because that's debt. If you're going down the investment strategy, that's debt that you cannot write off. Where unfortunately, not like America. In America, you can write your own interest off on your mortgage in your IRS tax return. But here, you can't. So in theory, that you need to get rid of. But then if you're only solely focusing on that, and if you're going for the investment-wise, then the one goal and one rule in investment is time in the game. So if you have an asset and you have it for 15, 20 years, that's you don't have time in the game because you're focusing on the owner occupied. But this is where the house price is difficult back to first home buyers. It's difficult to get in. It's difficult for them. It's difficult for young people wanting to be investors to grow a portfolio because we're talking about such large volumes in money. And then we're going to have new rules coming in, which are exactly the same principles, but just different setups. That's what it is. So, yeah, it's all on the client situation. But yeah, if it's your owner occupied and you don't want to invest, take the mortgage. If you're an investor, well, we want to maybe focus on trying to expand, build the portfolio, but then we also have to have in the back of our head let's take the home loan.
Yeah.
And you even see some clients rent vest, which the 4-letter word rent, people go, oh, rent, but especially in certain cities in the world, like if you want to live in downtown Sydney and you want to live that lifestyle in your young 20s and 30s, like earning, working hard, you're never going to live in Vaucluse. You're not going to be able to afford it. But maybe you buy, rent it out, and then you still rent there, and you can be a bit more. Yeah, that's
you can obviously live a different lifestyle than what you can actually necessarily afford. Let's call it.
But you've got skin in the game,
exactly,
as well, because you've got the asset still moving.
And so, how does it work in terms of like thinking about getting that house? In terms of you've got a house that you're buying, which say is 2 bedrooms, right, and you're planning on being owner occupied. But when you go to the bank and you say, okay, actually, I'm going to look at a 3-bedroom house and I'm going to rent out one of those rooms. Yeah. The banks look at that, correct?
Yeah, of course. Yeah, border income. You can use border income. The only thing is you're not going to be able to go to the bank and say, I'm sticking 3 people in 1 bedroom. The bank, 1 person, 1 bedroom. And also, if you've got kids, if you're a family, you've got kids, then you're not going to be able to... each child has to have a room. But yeah, you can use border income. Again, how much deposit you've got is going to dictate how much of the border income you can use as well. But yeah, no, it's definitely something that we really, we see clients use a lot, because especially first home buyers don't have children, might be a couple, may have bought a 3-bedroom house. Well, why not rent out 2 rooms to your friends? It's going to help.
Yeah.
It's going to
$200, $300 a week.
Yeah.
Yeah.
Well, geez,
it's like $12,000 a year, I think, roughly, if you're getting $300 a week.
Yeah. Well, and that's the thing. People will go $300 a week. Like, well, in certain places in Auckland, maybe it's the amount will be
easy.
$300
a week, I think, especially for a couple, that's almost cheap now. I mean, Auckland, I know that I've got friends that pay for a small room.
Yeah.
And it's not even well insulated, and they're paying minimum $250 a week for 1 person in Auckland. And I know down here in the Mount, it's not that different from that.
Yeah. I had a friend back in the day. He was a builder. He was putting stud walls up in his rental, filling them with backpackers, paying his own. He wasn't paying a penny of rent. They were paying the rent for him on the house. But it's just this whole, everything's so expensive, and you can reflect it from house prices to boarding.
I remember actually just thinking about people finding ways to. So you've obviously got like rules around like bedrooms need to have light and everything else, and I think same with bathrooms. I think they need to have a window now, I think. But anyways, I remember going to one of my mates' flats when I was at uni, and it was this massive house, and as a flat, they all decided that they wanted their rent to go down. So they had this lease for a minimum of a year. So they built, one of the guys was a builder, so they literally blocked off the entire lounge and built 2 rooms inside this lounge.
Yeah, wouldn't surprise me.
And then they were like, well, when we need to move out, we'll just take the wall down, paint it all up, and it's done. But in that time, you've got your extra rent. And it was hectic because the landlord, it wasn't through like a property manager or anything like that. So the guy apparently was it was done it direct.
Yeah.
The guy lived in Australia.
Yeah.
So he was never going to come and check the property.
Yeah. It's a bit fast and loose. But we all know those stories, especially years ago, of, a bit difficult if you've got a property manager these days.
Yeah.
But it's just 3 years, like 300 a week for a room is.
Yeah. And so with the way that, like, I guess finance has changed, just general finance has changed over the last few years, it's so accessible, right? Like, you've got things like, you've obviously got credit cards.
Yeah.
But outside of that, you've then got Afterpay and all these other, like, general purchase things like Q cards and things that are just so easy for people to get access to.
Yeah.
How has that changed the way that people are able to, one, get mortgages, but on top of that, like, just get finance, especially if they've defaulted?
Yeah, the thing is, even what people won't realise is your Afterpay, PayWave, Kalana, if you're in the Northern Hemisphere, there's a handful of them these days. In theory, that's like probably you're viewing it like a car loan. You're actually taking out a loan, whether it's at $3,000, $2,500 limit, whatever it is. There's no difference. Like, there's no difference to a credit card, car loan, personal loan. So that especially when we're looking at clients, trying to gain access to purchase, there's so many moving parts here that you need to go through that because there's such a norm in society, people actually forget what their principles are. Oh yeah, sweet, yeah, I got Afterpay. Yeah, no drama. It's like, but you got $2,500. It's like, you got $2,500 personal liability against yourself. You need to pay that off. Oh really? Like, because that will all be factored in. Same as a credit card. You've got a $10,000 credit card, and you'll normally see clients having to reduce their limits, maybe close it, because if you have a $10,000 credit card, even if you have the balance zero, we've had so many clients go, yeah, but I've got zero on my balance. But it's like, Lawrence, you get a bit excited tomorrow, you've drawn down your loan, you've got a $20,000 credit card, and you go, well, I'm going to buy a motorbike. Whacked. It's fully just ticked up. So it's got to be viewed as that liability. But we are such a consumer society, and the accessibility to it, there's a lot of moving parts. There really is a lot of moving parts. And but especially you pay now, buy now, pay later kind of stuff. Yeah, that's rough.
And so how does it change then in terms of the
reduce your lending?
Yeah, like in terms,
capability.
So it reduces it, right? But then on top of that, everyone always talks about like your credit score, and you need a credit score, like, because if you've got no credit score, there's no way of sort of showing how that works. So how does it work in that regard then? Because if you don't have a credit card or anything and you're not paying that off, do you get a credit score? How does that work?
Good account conduct. This, potentially you could say, it's not an urban myth, because I don't want to get myself in trouble here, but just be good. Like, pay bills on time, save, have good due diligence in your banking details, and then when it comes to a loan, you're not really raising a massive issue. If you've got debt ticked up everywhere, that can raise a question of, of why, when we draw the loan down, is the client going to revert back to ticking up Afterpay, going on to getting a personal loan? Just good account conduct. People just forget is just is the goal that I would achieve. Have good account conduct, progressive savings, pay your bills, don't default on things. Credit cards are dangerous for a lot of people that can't control their spending.
Yeah, I'd agree with that. one of my ex-partners didn't understand credit cards and how it worked when she first got her credit card. And she was like, oh, I got a new credit card, came home, had like a $3,000 limit, and was like, this is great, ASB credit card, woo! Went and spent all this money, and then like after 2 months, she was like, why am I getting all these fees? And I was like, because you haven't paid back the $3,000 that you've just spent in the last like month. And then it was like crazy high interest rate because it's credit card. It's not like and then it was the whole process of changing that.
Well, I would see it firsthand also. In my in my previous life on the rigs, what you're doing is you're giving young men high incomes with no responsibility. This is a recipe for carnage. So I would see whether it's British boys, American boys, Australian, European, I would see them go out and do massive purchases.
Okay, what were we talking about?
Yeah, I was gone then. Now, talking about, like short-term debt, credit cards, like, guys are like, I saw it with like guys on the rigs coming in, earning good money, but no financial education. Like, the schools don't teach us it. Yeah, guys going out. Yeah, okay, they're in the six figures. We've gone out and bought a $100,000 truck, like, and we're up to our eyeballs in it. And then where there's always high risk, there's high reward, but we forget about the high risk. Versatile, difficult industries, like the oil industry, you can get laid off tomorrow. Oil price changes, 5-year contract, au revoir, thanks for coming. Then what are you going to do? Got a $100,000 loan on your brand new Land Cruiser. Think fast. So yeah, like you see it, and it's I just think you can't go wrong with good financial discipline. Save money, pay bills, show consistency. Credit cards are just if you can't control your money, stay low.
Yeah. And so we touched on it just before around house prices. Like, they have gone pretty hectic. I think you said it, we've had 10 years of growth in 2 years. Is that right?
Yeah. So, I say so. An ANZ economist said the other day, because there's been obviously the time frame of as time keeps moving, keeps changing. But over 2 years, of the COVID period, boom, 2 years of growth, you had 50%. Now that's 50%. The rule of, like, if you look at the long statistics, the rule of average is over every 10 years, the house price priced up 50%. There you go, it's gone up. But that went in 2 years. But then if you look back a bit, not too further, in theory, in 10 years in New Zealand, we see, so 2014 to about now, if you actually look at where house prices were in 2014, you've had like another 2x from where the 2014 prices were. So in theory, we're looking at 30 years of growth in 10 years. Wow. That's a movement. And that's why we're in a, and it's not just us. This is global. Other countries are more hyperinflationary than us. Than others. We're probably one of the fast and loose ones, but because we don't have a high tax system, don't have stamp duty, we do have capital gains, but it's not really you can work around it, whereas in other countries it's not negotiable. Like, you're paying tax. And I think we also need to, sometimes we forget, if you're paying tax, you're making money. Like, you're making a profit. So, house prices, they've gone wild. But we've got debt to income ratios coming in, which will mean you can only borrow a specific amount of your income. So for an owner-occupied, it's 6 times. And for an investor property, it'd be 7 times. currently, right now, with the way that interest rates sit in this market, your borrowing capability anyway is only about 5 times. So they're actually, even though that everyone's talking about them, they're totally inactive. But when interest rates do start to drop, when maybe later in the year, but potentially next year, or the way that the Reserve Bank's talking, is then you'll start to see these come into play. But what does that mean? That means that the 2 years of property double in price, the game is over. It's done. It's never doing that again because, and if it does, I'll eat my words. I apologise right now. But it won't be allowed because now the Reserve Bank has that tool that they can change it. If the housing market's is starting to really cook, then they could go, okay, sweet. We did say it's 6 times. We're now doing 4. We're now doing 5. You know, they can move it to adjust it to control the market. That's why the game's over. Of your property going up 200 grand.
Oh, it was hectic.
It is.
There was like, I remember going to like basically during COVID periods, looking at houses, and it was a pre-auction offer was accepted. I think it was a pre-auction offer of like 1.2. And then at the auction, which happened like 2 days after, because obviously vendor is happy with the price.
Auctions comes
forward.
Showtime.
It went for another $300,000 above what he was already happy to accept. And it's like, how does that even... It's only valued at like 1.1 or something like that.
And that's what... craziness. That's what craziness does. And then now we're in situations where people are like, oh, if I was to sell, like, definitely not going to get that. Now, I'm not saying, I just want to reiterate as well, I'm not saying property's not going to go up, because it's that slow burn. It's that original model of what property was. Of if you acquire a house and in 25 years' time, your house will have increased in value. Yeah, it's that slow burn. But with again, probably our generation, the millennial generation, with instant gratification. Like, I want to make 150 on this house while flipping it in a year. Like, wow. It's with the way that the market is. I think we've got periods of.
And how does that work then, you reckon, for property development? Because obviously, like, property building prices are at an all-time high at the moment.
Absolutely.
Like, it's actually hectic. My brother's a builder. My dad's a builder. I see how that whole game is.
Well, they must all be driving Bentleys.
Yeah.
But then, yeah.
Yeah, it's like, because obviously if you're wanting to build a new house, I know that there's lower, like
20% deposit if it was investment.
Yep.
But the numbers just don't stack up right now. You could probably, so it's probably going to cost you $1 million. This is a generalization, but in the I'd definitely say in the Golden Triangle, Auckland, Hamilton, Toro, going to cost you $1 million.
100%. At least, I mean, like, to build a new house, a basic house, realistically, minimum $650.
You may get you'll probably get slightly less with some of the group builders.
Yeah. But it's whether or not you want to be.
Let's not take that fact away. The reality is it's cheaper to buy an existing property, which is now going to weigh up the question, because we've got so many moving parts, because we're a young country, there's so many moving parts here of what about this, what about that. Is it's cheaper to buy existing? So how long can the builders, they sit out in the cold? Because not everyone can sit out in the cold for too long. But then something needs to happen at it coming down. But then there's also two sides to the story. New Zealand's a young country, we've got immigration, more people want to come here. And we're going through a period now where we haven't really built a massive amount of houses for the last 2 to 3 years. So what's going to happen, because there's going to be that whole supply and demand, we're were actually secretly in a glut. So there's me going, house prices aren't going to be able to go, but then that's because of the lending criteria. If you're paying for it in cash, then house prices could go. But the cost to build, the cost of trades, their materials have gone up. It is astronomical. I was actually talking to a builder a few days ago based in the Mount, and we were laughing because I was just gauging a rough average per square metre of how much it would cost to build this and all different kinds of scenarios. Pretty daunting when you hear what the average cost per square metre.
What did he say? I've heard 4.5.
Oh, he was a bit higher, but we are talking a high-end... He was talking a high-end market, but he was up near 5 to 6.
Yeah. Did you... this is something that's really interesting. I was talking to a couple of IP lawyers about this. But have you seen what Zuru's doing in the building industry?
No.
Oh, dude, you have to watch this or look at it. Zuru Tech. Basically, you have a 3D CAD house that you can build on their website.
Yeah.
It's all built in, I'm pretty sure, in China.
Yeah.
I think it's something like $108 per square meter to build a house.
Well, this isn't a new phenomenon. You've got a German company, because my wife's an architect and she helped back in the UK when we were living in Europe. A friend of mine built this eco house. It was a flat pack house. The whole thing was prefabbed in Germany, shipped to the UK. Thing took 3 days to construct, all put together. So I think, especially for dynamic thinkers, we want to think,
or even
we've got to think differently of how we can be more creative.
Well, I mean, and if you look at the housing crisis in New Zealand, of there not being enough houses, I mean, the kings of the building industry, Fletchers, are going to be challenged by the likes of Zuru with these sort of things for building those state housing and things like that. Because what would you rather build? What, something like that, or something that's going to cost you, let's say, $200 a square meter? You've got to have builders come in, build it really fast. It's done.
We also want to build with longevity.
Yep. But these houses look epic.
We want to build with longevity. We want structures to last. We don't want to be building for it to fall apart in 20 years. Which, yeah, you look at, especially in Europe, some of the walls are you think you're in a bloody bunker, how thick they are. So I'm not saying we can build because of obviously the grounds. Yeah, and I'm not a builder here like that, but we need to build cleverly, and we need to build correctly.
Yeah, no, 100%. But I think it'll be interesting to see how disruptors in the market like this come in, because everything's built in a factory which is lights out, all done by robots. So there's just it's 24/7.
Yeah,
it's all prefabbed, it's all lined with wires, everything. All you need to do is literally just put it all together. And then once that's done, it'll be interesting to see how that changes the building industry.
It's definitely a hole in the market for a disruptor to come in and change.
Yeah.
Change is good sometimes. So, but in the long of short, back to where we originally were, existing properties are more obtainable right now. Yeah, there is the cost of if you're going to renovate them. Building cost is massive. But yeah, new builds, they're just, a lot of them are way out. They're just so expensive. They're just so expensive. And it's a difficult one to go past.
Yeah.
And I'm sure you will speak to a new builder, new build group one day, they must be hurting right now. because their volumes would be down. But yeah, it's definitely an interesting space, I would say. Yeah. But,
Cool. And so I got 2 final questions.
Far away.
First question is, what would you say is your recommendation for business owners looking at, like, how would you recommend a business owner structures their mortgage or things like that?
Business owner, well, it all depends, cash flow of the business, how their business is operating. A quick thing that people don't realise is your business debt is against you as well. So if you have a delivery business, you've got 4 vans in the delivery business that are all on hire purchase, that will be leveraged ultimately against you as the individual. Obviously, there's factors in there, the interest and all of this can be a write-off, but different banks also work better for different businesses because of the way that they read financials, what they can add in and what they can add back. Business owners, like especially if you have a revolving credit facility, which is where you can have a large sum back, it's different with banks, at least a couple $100,000 is easy. Again, gone are the days of $1 million revolving credits, but there are individuals out there that still have them. That's a great facility. So you can, if you've got a lot of liquidity coming through the business, then you can just sit it to work against the asset.
I'd say the biggest actual thing for business owners, which we were talking off air about a minute ago, was especially your startups. If you want to buy a house, sit down with your broker and your accountant together, because where an accountant views you and where a broker needs you to be, 2 totally different places. Accountant, they're fantastic at paying. Their goal is to pay 0 tax. If you're paying a lot of tax, get an accountant. If they haven't, if that's your goal. Where we need you to pay tax, because back to the old comment, you're paying tax, you're making money. We need you to make money. Even if you write your life off through the business, the bank can't just go, that's all good, Lawrence. I understand that you're doing this, this, and this. But triple CFA due diligence, they can't do that.
No.
So you need to see the bottom line. So this is where, unfortunately, we do see quite a few startup junior business owners, they're just writing their life off. Which, if you're trying to buy a house, maybe not a good idea. But really utilising, it all depends what kind of business you've got, how much cash flow, but facilities like a revolving credit, they're great for business owners because you can double dip. You can have it working for you, and you can also, if times are tough, like we're in a quiet market, nationwide, speak to builders, everyone. Everyone's a little bit slow at the moment because of recession. The teeth of the recession are starting to bear. So you've got that liquidity pool as well that you can just pull out if you've got it loaded up against the mortgage. So that's what I'd say for business owners, And have a chat to your broker. Tell him or her, tell them what you want. What do you want to achieve? Where do you see yourself going in the next 12 months? That's what we're doing that way.
Cool. And so who would you say is the best bank for business owners?
Can't do that to me. Nah, I can't say because I don't want to get myself in trouble, but there is big differences. There is a big difference because of how they read the financials. And also, it's like tides. Certain banks are more open to business than others at different times. So it's all like jugs of water. The bank fill their book up. They're happy with their full jug. Others might be empty and they're like, well, we need to go out there and get some business. So we might take a risky marketing agency on and, lend them the money for that, it'll be a disservice to say who's better than the other. So I can't say that. Good try though, but yeah.
And final question. If you're playing roulette, would you go red or black?
Red.
Red. Nice. Superman, eh?
Superman. To fly with fast. Okay, red.
Sweet. Thanks for coming on.
Awesome. Legend.
Thanks for tuning in to another Squid Group podcast. If you're looking for a marketing partner to grow your brand, business, or event, contact us here at Squid Group. See you next time.